companies. I do just need to read one piece of compliance wording. So this call is for professional investors and eligible counterparties only. Any views expressed in this communication are those of the fund manager and are subject to change without notice. They are not necessarily the views of Unicorn Asset Management and do not constitute investment advice. Your capital is at risk. Past performance is not a guide to future performance. Simon, over to you.
Thank you very much, Alistair. Morning, everyone. Thank you very much for your time today. I missed the last one of these updates, unfortunately. I was, I think, in hospital at the time with my new baby daughter, so had some other things to do, but with apologies. Hopefully, this update shouldn't really come as too much of a surprise anyway. So what did we do? What did I do in response to COVID-19 and the outbreak thereof? You know, we took the early decision across pretty much all the funds at Unicorn to reduce end market and balance sheet risk. Any significant outliers within the portfolios were removed pretty quickly. The good thing, the positive was, you know, at Unicorn, we focus on balance sheet strength as one of our core disciplines when we're assessing a company, and the ability to service debt for those indebted companies. Obviously, this is tied up within that, but we did enter the period with low levels of debt, which obviously got strengthened as we went through the period. So, you know, we wanted companies that were able to navigate this lockdown, and those better finance companies will emerge faster and more sharply, you know, when we get some more clarity, when strength comes back to their end markets. Talking of end markets, you know, we had to assess which companies were facing end markets essentially either in shutdown or ones that would be significantly impacted. And if you combine those two, the balance sheet strength or high levels of net debt or higher levels of net debt and end market risk, well, then those were pretty easy decisions to make quickly when we saw this unraveling. And though it looks like only, you know, on a net basis, only one company was removed from the portfolio, there was a higher level of activity from that, and I'll touch on that momentarily. Where are we now? You know, the outlook is one that I'm pleased to say with company updates, you're seeing compared to where you were in March and April, which was, we can't give you any guidance and we can't really give you much sensible commentary on what is currently happening, apart from there's a significant amount of disruption. That was pretty much a textbook update for March and April from any of these companies, which, you know, the whole time was pretty galling to read, but understandable as well, given the significant nature of the disruption that was occurring at the time. What you've seen in the last few weeks is companies updating the market with actual, you know, sort of actual tangible updates in black and white of where they're seeing activity now, and you're able to make a better judgment of that, perhaps whether that either recovers further or persists at that level, and the actual financial health and operational health of those companies that are updating. And I'm pleased to say that broadly, of those companies that are updating recently, they are better. You know, they are able to put forward levels of activity, schedules that are looking much more healthy than they were in March and April. Current portfolio is very well capitalized. I think about half or just over half the companies within the portfolio have net cash on the balance sheet. Of those that have net debt, that net debt to EBITDA level is around about 1 times, which is very low compared to the wider market. And I think that will become a ratio you will hear more and more often through the next sort of 6 to 12 months as companies generally within the market, well, either fall into emergency fundraising or fall into just more stressed financially, more stressed positions. And the final bullet point there is, though small companies are always hit harder in sell-offs like this, they historically recover faster as well and far more sharply. And you've got basically a portfolio full of companies that are well capitalized, generally operate in specialist fields that are able to recover quickly during a recovery. Touch on performance here. Strong long-term performance against very tough benchmarks over my management tenure. On the left-hand side, that focus on high-quality companies that, for whatever reason, are trading at lower than the historic multiples. It has tended to help performance over time. And I'm pleased to say there's been some opportunity that's been thrown up in the short term. So if we look at year to date, in line with broadly in line with the NSCI and the NSCI plus AIM, which is where you'd expect me to be. Positive sector exposures over this period have been leisure goods. So for that, computer games developers. Negatives have been sort of this fund has always been overweight industrials, and they've obviously been hit hard. And when you're hitting a sharp downturn like we have, and travel and leisure as well, which has been significantly reduced during the start of this period, and just generally as an observation, as I mentioned, small companies are harder here. Performance attribution here. The purple line is I suppose value added through stock selection. You can see that that's almost universally above zero. So usually adding value with stock selection, which is quite pleasing to see. And asset allocation broadly does what it does. As if you were listening to the previous presentation, I mean, that is primarily predicated on those sectors which we exclude. So pharmaceuticals, oil and gas, miners. And as you'll know from those commodity focused too, especially, they can really wing around. So whether the oil price has a tremendous run or tremendous fall, this portfolio won't tend to react off the back of that, and can sometimes outperform or underperform through the lack of exposure there. So strong selection has driven long-term performance, and broadly following the benchmark, following the recent sell-off, and that asset allocation affected by the long-standing sector exclusions. The activity over the last 12 months. Well, let's look at the bits that aren't in red first of all, because you'll see here, top right, about a year ago, I sold Hill & Smith, and about a month and a half ago, or 2 months ago, I bought Hill & Smith, which is fairly unusual for us. But Hill & Smith is a company that's very exposed to infrastructure spend. It's a very high quality company. It's got large galvanizing bars in North America, Europe, and the UK. Lots of structural equipment will need to be galvanized. They also make temporary road barriers as well, which if you're obviously doing any sort of road works or large scale road works, you'll use. They, in July 19, I think they were trading at a PE of over 16 times. When I put them back into the portfolio, and that's when I sold them. When I put them back into the portfolio a couple of months ago, they were, I think, just under 13 times. So a significant derating there from what I would say was a company that was exposed to relatively strong end markets. But just generally on those additions and disposals over that 12-month period, that's about right. When you're removing the red boxes, what you have had though in the last few months is I suppose extreme market conditions or economic conditions caused by COVID-19, and that has driven a few of those disposals. So Card Factory, Gym Group, and City Pubs were in direct response to that. I took a dimmer view on when pubs might reopen. So sold City Pubs, Gym Groups, again, that enclosed spaces. There was really no guidance at the time, and with the reopening, I think I'm probably a little more cynical than others of people's appetite, certainly the larger market, of people's appetite to want to spend time in enclosed spaces with other strangers. And Card Factory as well, with the high street shut and all their stores shut. I took the decision to exit that one. FDM is a bit of a different story. A holding that's been within the portfolio, I think this was its third time in, one that really does move around. It's a specialist staffer. It moves around with market sentiment a lot. It's incredibly high quality. They tend to focus on IT and technically able graduates, train them up and place them into positions either within the public sector, the financial services or technology companies, and it was obviously beaten up. I added to it a lot over the period, and I think about 2 years ago or a year and a half ago, came back into the portfolio at a very low valuation. It just recovered enough in a very short period of time for me to want to take profits on that. On the addition side of it, probably more relevantly, EMIS is a software provider for health services in the UK. They were really caught up in the sell-off for reasons best known to the market. It shouldn't have fallen 30%, but it did. It's incredibly robust recurring revenues, net cash on the balance sheet, exceptionally cash generative. And we've looked and admired this company for many, many years, but it's always been too expensive. But when it takes a completely unwarranted bath of 30%, it was a rare opportunity to pick this up at a cheap valuation. And likewise with Hill and Smith as well. And I've already touched on that, but Gooch and Housego, a precision optoacoustics business. They make equipment for satellite communications, for making wafers for CPUs, incredibly high-end stuff, and again had taken a bath with the wider market, and certainly and I just frankly hadn't really recovered when the market took a leg up as well. So I took the decision to introduce that to the portfolio again after I've known that for well over 10 years, and I've been meeting them for over 10 years as well, and admired it. It's been within one of the other funds at Unicorn. It was been in OBC for a long time, but known it for many years and admired it, but it's always been fairly pricey. The full portfolio here, probably worth picking out just a couple of examples of that dynamic I was talking through earlier, that trend we're seeing over the last few weeks of companies that were unable to provide any sensible guidance a couple of months ago, then have been coming up with really reassuring guidance. So Goodwin stands out. This is a company that makes large scale forged steel. If you think of the bow lines for boats, specialist equipment for submarines, right the way down to slurry pumps for dredging or mining. They were unable to provide much sensible guidance to the market until a couple of weeks ago. Their order book is currently still exceptionally strong. None of their businesses closed over the period. They're all operating well at the moment, and to have that assurance from them and that level of confidence they have, obviously, to put that out publicly in the market in black and white is a tremendously reassuring and a very, very different tone than we were hearing from many companies just a couple of months earlier. Castings as well, cast iron, ductile castings, producer in the West Midlands to the light truck market. In March and April, we had a call with them last week. In March and April, their schedules were down between 80 and 90%. So they were operating about 15% for a month and a half, for 2 months. They're now operating at 70%. So you've seen a tremendous recovery within the market, within their end market, which if you come back a couple of months ago, you just wouldn't have foreseen. And I'm not using these two as an example to say this is a V-shaped recovery at all. I frankly don't think it is. It may well be in some sectors, but you're taken as a whole, as a mosaic. I think you'll see more like a Nike swoosh with a sharp drop down that we've seen undoubtedly, and then a more steady recovery rather than a fast recovery. I think probably worth just touching on a couple of companies that have done very well: Codemasters, Frontier Developments, both computer games manufacturers. You've seen furloughed staff, people stuck at home, bored, frankly, want some entertainment, and there's only so much Netflix you can watch, I'm sure. But they bought computer games, which these guys make very, very well. Codemasters makes driving games, Frontier makes sort of management games, and really, really interesting, quite sort of cerebral stuff. And they've got customers in a very beneficial way, because no one's able to go down to shops to buy the physical copies of these. So they will bought digital downloads, which again, number of sales has gone up, but margin on those sales is far, far greater. But also when you achieve a digital sale, you've got a point of contact with that customer for the next X amount of years, and you can engage with them, you can market games that you know they like. So very positive for them, and there's no real surprise that that's been the best performing sector within the fund over the last couple of months.
Thanks, Simon. Got a few questions that have come through here whilst you've been speaking. One of them, I think you sort of touched on this a little bit, if you can unpack it in a bit more detail. Have you found the speed of the recovery surprising?
On a market basis, yeah. I think the market being so keen to recover is indicative of a lot of people not wanting to miss the bottom. It looks so different from what we saw in the global financial crisis, where you had at that point you had people just not wanting to touch equities for a long time afterwards, and so you had this very, very steady and stable recovery. And you really, in the terms of market valuations or market prices, you've had almost a V-shaped recovery, and I am finding that fairly surprising, because you've seen a lot of companies with this end market risk I spoke about earlier, who are going to find the world pretty tricky for a long time, and we don't know the way Joe Bloggs is going to want to interact with the world when all this is over. We don't, frankly, when it's going to be over as well. We have no idea when a vaccine's going to come through, that sort of stuff. So I don't know why, like I said earlier, I don't know why you'd want to spend your free time in a room with plenty of strangers in close proximity. So yes, for certain sectors, distressed companies, ones that were really sold off, have in many cases recovered very sharply. They may well have they stressed balance sheets and a really uncertain end market. Yeah, I'm surprised by the recovery in some of those companies.
Thanks very much. Another question: where are you seeing the best opportunities in sectors or companies? Was the question. You've touched a little bit on some companies that you think are trading very well and have really good prospects, but are there any sort of sectors as a whole that you're seeing really good opportunities? And I suppose the flip side to that, sectors that you're just avoiding?
Yeah, well, industrials, financial services, I think both of those sectors are, they were sold off, understandably. They were sold off. They tend to be quite hard hit when you enter a downturn. And I'd say that they do represent broadly pretty good value. And Fraser spoke about Numis in the previous presentation pack, and that's another one that's in Smallco's. They are raising money for companies that need the money raised, and through all of this, I wouldn't. That's not really something to crow about, but there are plenty of companies that do need to shore up their finances. And the likes of Numis can raise money, and they've got a very good track record of raising a lot of money very quickly, and they still get a fee for it. They're not doing any IPOs because you frankly be mad to IPO in these conditions. But if you are on the public markets and you do need money, and your banks aren't being cooperative or are being slow, well then the likes of Numis can do it very quickly. But also financial services companies like the likes of Polar Capital that take a fee on a very set AUM amount. That's far more stable revenue stream than it's really given credit for by the market. And companies like that shouldn't really surprise, but they have more stable earnings than the market gives them credit for, certainly. And you asked on sectors that are overvalued as well. I'd say some. You have seen sell-offs in travel and leisure. Some of those companies that, some of the companies that got distressed and then recovered significantly, I'd say probably represent some overvaluations within the market. What I'd say, just as a broader observation on this, is there's a couple of slides now. You're on the first one that the UK equities look cheap. Just broadly, if you're looking for good value. This slide sort of demonstrates that you're sitting at a 30% discount to the rest of the world. And I know the whole world's taken a bath, but this is a fairly significant discount, and you can see that for the last 20 years you haven't sat at this discount. On the next slide is the slide we began with, which is within the UK, small caps are cheap. So the UK is cheap, and small caps are cheap. And from discussions we've had in the past that I rank the portfolio and opportunities within it and externally to from where companies are trading against their historic averages. And that's a lot harder to do at the moment because consensus forecasts in small cap land are utterly pointless. So what is not utterly pointless, but they're far harder to sort of hang your hat on. So what I would say is that within the portfolio, there are some companies that represent really good value, which I'm adding to. Those additions represent a really good value against the historic averages, which I've added to. But there are plenty of opportunities out there still, just generally, but they tend to be rather on a sector basis, on a stock-specific basis.
One question, which is I guess asking a little bit more about the sort of the recovery and what's been leading it. Have the most affected companies not actually lagged and tech and healthcare led since the bottom? Investors seem clear on future winners and losers going forward.
Sorry, Alice, you broke up a tiny bit then. I couldn't quite. Can you repeat the question?
The question is, have the most affected companies not actually lagged and tech and healthcare led since the bottom?
So it's a view on those
been leading the recovery. I suppose.
No, I'd say that's a good question. So I guess it ties in with my previous answer in that you've had some companies that are distressed and they've lagged, but they haven't really because the market. I know that's a really good question. I
suppose that the one thing that we've been doing quite a bit of work on this for some of our investors with regards to some of the portfolio, for the guys that invested with you, and it seems that there is a bit of a disparity between larger companies that have recovered and smaller companies that have recovered. Certainly there's companies that you guys would have picked out in the presentation that yes have recovered very well, and because they are trading very well. But some others that you have absolute conviction in that don't seem to have recovered relative to their large cap peers.
Yeah.
Have you seen a bit of a story of sort of big versus small there, and is that driven by a weight of money or just lack of coverage?
I think it's and it's a really good question. I think this chart is about as explanatory as it could get onto it. That you do have that money that flows towards the perceived safety of larger companies, and that is always at the cost of small cap valuations. But there are really good companies. Gooch and Housego is a fantastic example that it recovered slightly from its sort of fall and then recovery, but it's still miles below the valuation it was at in February, and it's just sort of tracked sideways since then. I think you would have had, if it was a larger company, it definitely would have recovered in a stronger fashion. But that's the joy of being a small cap fund manager, is the fact you can search down here and find companies that are at the wrong valuation.
Yeah, thanks for that. Look, I think there's no more questions on this at the moment. So, thanks very much for giving us a bit of an update there, Simon, on the Smaller Companies Fund. We are going to be back in around 3 minutes, it looks like, with the Outstanding British Companies Fund, with Max Ormiston and Chris Hutchinson. But otherwise, thank you very much to everyone for joining us, and thanks, Simon, for your time this morning.
Yeah, thanks everyone. Goodbye. Stay safe.